With Diamond Realty and Loan. So we do these webinars the first Monday of every month, actually. We've been doing it for quite a while. Of course, I've been a broker for over 20 years, seen a lot of different loan and real estate issues, and learned a lot, had a lot of fun, helped so many people. We get these topics from people writing in with a direct message, text, email, call, and we go through them and we pick which one we want to do, and eventually we'll do them all. But feel free to send your suggestions in, and and if it's important to you, let me know, and we'll just make sure and put that on the agenda. So this month's topic is cash out refinance. Now, why would you do a cash out refinance? There's a lot of different reasons, but cash is king, right? So if you have real property, whether it's personal residence, second home, investment property, or even in a trust, you can do a cash out refinance. You get part of that equity to do what you choose with, and then you still own the property. So you didn't realize a capital gain. So there's no tax burden in reference to that. You still own the property. You just took part of the equity, right, to do what you chose with. So you still own the property, so it's still going to appreciate at its normal rate. If you bought the home for $100,000 and it appreciated to $200,000, you have $100,000 in equity. You can pull a portion of that out, but the home is still worth $200,000. And remember, homes appreciate. It's up and down. Sometimes not as much as other times. During COVID, it was double digit, 18 to 20%, depending on the area, of appreciation of the total value of the property. Of course, prior to COVID and 40 years prior to COVID, the average appreciation nationwide in the United States, 4.2%. So remember, that's appreciation on the entire value, not just what you invested in it, whether it was a 5% or 20% down, or whether it's a $500,000 house and you only owe $100,000. The appreciation is on the total value. Monies that you take from equity are loans, that's debt, that's not taxable. So you then can do what you choose with. So I just want to make sure that's really clear. So what could you do with it? Well, it's totally up to you. My recommendation is definitely have a plan of what you want to do with the cash prior to taking the cash, because there's no sense in incurring interest expense for no great reason. So, if it's just to have financial security, you just want it sitting aside because you don't like what's going on, totally understand that. That makes sense to me. Of course, there's a vehicle for that. We'll get into the different types of how you can pull equity that would be best for that. Maybe you want to expand your business or start a business. Now, that's a great opportunity, great possible use of that cash. Maybe you want to pay down some high interest debt. Fantastic. Remember, credit cards right now are, 24, 29%. If you were to blend that interest rate and that payment with what you would be saving, you would save hundreds, possibly thousands, depending on what you owe on credit cards. Or another one that I often run into that people often don't think about is mortgage insurance. That's a great reason to refinance you first while refinancing, to get rid of the mortgage insurance that could be costing you $200, $300, or $400 a month. Besides getting rid of the mortgage insurance, you can then take some cash. It's going to cost you just the same to do the refinance. You might as well take some cash for one great purpose that you may have already decided on. So those are some of the reasons. You may have a different reason. Love to hear about it. So then what vehicles or mechanisms are there to actually take the cash? Well, there's a couple. Of course, you can refinance the first. That's the most common, sounds the easiest, and it probably is. They're all pretty similar and take about the same amount of time, 20 to 30 days, depending on speed of documentation and such. But if you're refinancing the first, you bought the house for $100,000, it's worth $200,000 now. Rule of thumb, you can take 80%. So you can take another, $60,000 out of the property as cash. You get the closing costs of a couple of grand, whatever, boom, you're done. You've got the cash, it's in your bank account, you have a new first, and then I always hear, Dave, my interest rate is so low, I'm never touching my first. I understand. But remember, we talked about high interest credit cards and blending the rate. It's possible that just with a couple of math problems, we find out that, hey, you're way dollar ahead to to refinance your first. But you don't want to, I understand. The next possible vehicle for you is a HELOC, a home equity line of credit. Now these are fantastic, and these are per diem interest. So there's a lump sum, we'll go with the same scenario, 100,000 purchase, 200 value, 60 cash available at 80%. So that 60,000 is now a line of credit. If you don't touch it, you don't pay for it. Now there's usually a $100 type of an annual fee to keep the servicing going on this, but if you don't take the money, then you don't owe interest. If you choose to take 10,000 of this, you only are paying interest on the 10,000. Also, if you pour your savings into that and your paycheck and your what, if you put all your monies into that on a per day basis, then that lowers the value or the credit that you've taken, so it lowers the interest expense because it's calculated every single day, right? 0.0003% or whatever. That number's wrong, but you understand my point. So if you put your savings in there, it reduces the balance, reduces your interest expense. Fantastic. You're only charged on the monies you take. Boom, one payment a month. Okay, now, if you do choose to take 10,000, 50, 60,000, the whole amount, right, up to 80% of your value, you can use that money for whatever you choose. Again, that's a loan, so you're not taxed on it. So you could use this for investing. Maybe you're a day trader and that would really put you over the top. Maybe your business needs to be expanded. Maybe you want to buy another piece of real estate and this will be the down payment and closing cost for that said property. Lots of different options, but you're, again, only paying on the portion you take. Another option is actually a second loan. So it's kind of like a HELOC, but it's not a line of credit, it's a loan. Usually 20-year term, so you have 20 years to pay it back, as opposed to a HELOC, which is interest only for the first 10 years generally. But this is a way to get the cash, one lump sum. You have two specific strict payments, your first and your second, and you have the cash. Now, you could pay it all back, but it's simply going to pay off the loan. Then you don't have the cash, nor do you have the loan. So you have the cash, you do what you choose with it, you have two set payments. Those are the ways to get the money. What you do with it, totally up to you, but lots of different options. Now, when should you do this? Okay, so that depends. Now, every single loan has three pillars. You've got income, credit, and assets in most cases, but you're doing cash, so that's your assets in this case. So income, credit, and market condition, which is the collateral or the property. So the value of the property can obviously fluctuate. Not generally huge, except for in 2009, 2010, that fluctuated a lot, but that was an anomaly. That really was Wall Street's fault. Seriously, it was. But regardless of the fact that it fluctuates marginally, you want to make sure and do these types of loans, any loan really, when your situation is solid. Income solid, assets are solid, value of your property is solid, credit is solid. If you wait until you really need it, you may not be in the position to actually qualify for it. So most all of these types of seconds or refinance on first, their best interest rates are with the most documentation. That's called a full doc loan or a paper loan. So that's where you're proving everything, tax returns and everything. There are lesser documentation loans, but those are with higher interest rates and generally lower combined loan to value limits. So we talked about 80% cash out limit. On an A-paper loan, it could be less, particularly if it's an investment loan, investment property. Your loan to value, combined loan to value could be substantially less. So it may not be as good of an option for you if the situation isn't 100%. You can always call and chat with me about these aspects, 15-minute conversation. We can have really a good plan of which direction for you to go, or whomever it is that you use for your mortgage lending and real estate. And if you don't have one, feel free to let me know in what area you're in, whether you're out of state or not. I have reps all over, and I have friends and associates all over. So we can certainly hook you up with somebody really good. So back to the three pillars, right? Income, asset, credit, and of course, the property. If you have any questions about documentation in reference to that, Google is pretty good about it. They generally do try and steer you into a Rocket Mortgage or a Flagstar or one of these guys. But the documentation, generally speaking, is pretty correct, but of course you can always call me. Lastly, I really hope that this answered a few of the questions, particularly of the 2 or 3 people that did email this in last month. They were simply asking, when's the best time? Best time is when you think you think it might be a good move for you, A. And B, one of the things that did come up that I just thought of is that interest rates are probably going to go down. At least a lot of people think they are. Personally, I believe they will go down, but I think that it never goes in a straight line, right? It never does. Whether you go up or down, they're going to definitely do one or the other, but never in a straight line. But consider if you were going to go, okay, Dave, I need the cash, I want the cash, I know exactly what I want to do with it, but I think interest rates are going to go down by 0.5 point in the next 3 months. Do the math real quick. It's simple. If you're going to save, call it $300 a month right now, with credit cards, no mortgage insurance, whatever. Let's just $300 a month, and that's 3 months, so that's $900. A 0.5% interest rate would take you a couple of years to accumulate back, to break even. You're still better off doing it today than you are in 3 months when interest rates are 0.5 point lower. So you have to consider that. We can do all this math for you, show you black and white. You could probably do it yourself. It's very simple, but you can't go into it with emotions. You have to go into it with the facts and the math. And those are simply the facts. And I really welcome your input, your suggestions, your comments. I do these, I really like doing them, so I obviously do it because it's fun, but I do it because people want to hear this stuff. They want to hear about these types of things on a basic person-to-person level. They don't really want to hear the high-end, I have a CLTV with a hybrid machine. They don't want to hear that, and I understand. But the one-on-one chats are where we get much further into any of this. I hope that this did help, but whatever topics you would like for us to chat about, I can bring professionals in, whether they're attorneys or appraisers, whomever, and we can have a chat with those guys or gals as well, and really help this channel to make it an educational, substance provider. That's our goal, right? Help everybody. So I'm Dave O'Hara, broker with Diamond Realty and Loan. We do this every Monday, first Monday of every month. Feel free to, like this, subscribe, follow, chat, send me a message. Let me know if this was helpful at all, if you liked it. All right, thank you. Have a fantastic time.